And then why I'm not showing? Let's turn it off. Stop video. Participant. Here. Join it.
Most importantly, I think you should let me in first.
I know. You keep popping people. Yeah. Waiting room. Where is shakedown sound? Admit first. So you should be in now. And then let me elevate you into the host. Turn on your. Yeah. Good. And then let's pin you.
I can't. You have to add more people before I can pin.
No, I can pin you.
Okay.
Pin to first screen. And then make host. Change host. And you're the host now.
Perfect. Good. And then you want you.
Yeah, that's a win. But we're not starting. We're starting like in a minute, right? We're gonna go up right now. Actually. Okay. All right. Yeah, that's a minute. But I just need a minute to get myself up there and everything.
No problem.
Okay. There we go.
Good. And 1 second.
There you go, right?
I'm not ready. So can I? Now you're host. I can get out, right? Oh my god.
You put it on?
Good morning. Good morning, everybody. Good morning. Can I please ask you to take your seats? Good morning. Good morning. How exciting is this? I'd like to welcome everybody to our first combined AGM between RE/MAX Health and RE/MAX Condos. We're super excited to have you today. We're looking forward to having a lively conversation. We have some fabulous speakers that are joining us. I want to welcome them and all of you here. And I also want to welcome everybody who's watching from the comforts of their car or their home or their office. This is being live streamed and it's also being recorded. So if you're enjoying this, you can always, within a couple of days, you'll be able to, watch the video again. It will be uploaded to the achievetheultimate.com site, and we'll cover a lot of where to find things moving forward. But today is also a very special day for another reason. As everybody knows, birthdays are very important to me. And we have to celebrate birthdays because there's a scientific study about them. But before we do that, it's Shauna's birthday today. So all together, happy birthday to you. Happy birthday to you. Yay! Everybody knows that birthdays are very important to me because there's a scientific study. I've always joked with everybody about this. The scientific study has been proven that the more birthdays you have, the longer you're alive. Yeah. Right? And when people say they're catching up, I say, no, I don't want to catch up. It means you're gone. Right? So, anyways, Shauna, wishing you many years of, continued years of health, and happy birthday once again. We're going to start off with our first speaker right away because we value your time, and I just want to make sure I get the bio correct. With us today, we have Sean Hillebrand, who's the president of Urbanation, a real estate research and consulting firm specializing in the GTA, condominium, and rental markets. Sean manages the Urbanation team and is responsible for leading market intelligence for the company's subscription reports and project feasibility studies and directing new research expansion. Sean has acted as a key spokesperson on the local real estate market for over 10 years, providing highly quoted market insights in the media, delivering industry presentations, and preparing forecast reports and customized research for a diverse range of clients. Prior to joining Urbanation in 2013, Sean managed the GTA housing market analysis team at Canada's Mortgage and Housing Corporation, known as CMHC. Please, a round of applause for Sean Hillebrand.
Okay. Yep, perfect. Okay, thanks everyone. I'm going to get this sorted. No. Oops. There we go. Bit of a delay. All right. Well, thanks everyone, and thanks Tim and team for having me here. It's certainly a pleasure to be here, and I don't think there's a better time than now to start digging into the data and understanding what's happening in the market. Certainly there's a lot of questions with respect to the market outlook, particularly in the short term, given what's been happening to interest rates. I think the market has certainly proven to be remarkably resilient, I would say, so far, in light of the fact that interest rates have quickly risen to a 22-year high. Housing prices have held up, I would say, reasonably well in light of the fact that we're dealing with interest rates that we haven't seen in a couple of decades. Combined with the fact that prices are still near record highs. Sales activity has obviously slowed down remarkably, but I think what's happened to prices is really a reflection of what happens in a supply-constrained market. So it seems as though we've seen some resistance to the downward pressure, but I can't stand up here and tell you that we're going to turn the corner and prices are going to start to skyrocket again. I think there's still some softness ahead, but if you look towards the medium term and the long term, I think there's a lot to be optimistic about. So I'm going to be talking about the market in general. First, I want to talk a little bit about the economy and inflation and interest rates, because it really is all about inflation right now. I won't say too much because I know Ted, who's much better than I am at these sort of things, is going to dig into a little bit more detail. But certainly you can see how hypersensitive the market has become to changes in inflation and interest rates. And I don't think there's been a time, at least in recent memory, where those in the housing market have paid so close attention to when the CPI numbers have been released and when the Bank of Canada makes their interest rate announcements. But you can see the Bank of Canada has done a very good job at orchestrating a slowdown in inflation. So in the middle part of 2022, we were seeing inflation above 8%, and that's been knocked down to around 4% more recently. But I think, the interesting thing is that, while we were seeing inflation move back down towards target level a couple of months ago, it's sort of since moved in sort of the opposite direction, which I will say wasn't completely unexpected, partly due to higher gasoline prices. And you can see from the table on the right there the factors that are contributing to inflation and those that are contributing to deflationary forces. But certainly the move in core inflation, which is really what the Bank of Canada looks at when setting interest rate policy, has nudged up, and that's causing some concern that perhaps there may need to be another interest rate increase. So I think the general consensus view within the economics community is that we have reached the terminal rate at 5%. We may see another quarter point rise. I think there's about a 30 to 40% chance of that happening, but we're pretty much at the end. And I guess the bigger question is where will interest rates ultimately land? Because there's certainly an expectation with interest rates having risen this high this quickly that there's going to be some economic repercussions. There's going to be a slowdown. There's going to be some deflationary forces. And the Bank of Canada at some point is going to have to start actually cutting interest rates. Now, they don't go out in there and talk about it. They say it's much too soon to talk about interest rate cuts, but certainly the financial markets are starting to price that in to a degree. Interesting also to note that mortgage interest costs are considerably feeding into these inflation numbers. So mortgage interest costs, which are a direct reflection of the Bank of Canada's increase in interest rates, have seen a 30% increase, and without that, you'd probably see inflation at around 3%, so right around the target rate, or the upper bound of the target rate. But definitely, inflation being a little bit stickier than expected is contributing to some expectations that interest rates will be higher for longer. And that's kind of the theme that's been permeating through the markets more recently. So when we saw a pause in interest rates earlier this year, it reignited a bit of an improvement in real estate activity, right? We started to see sales improve, the prices started to move higher again. But that happened at a point where the 5-year bond yield was around 3% or so. So since then, and we've seen obviously a restart in those interest rates, 5-year bond yields have moved very meaningfully above the 4% range. So that has translated into fixed-term mortgage rates above 6%. So this is a different pause than what we saw earlier in the year when fixed-term mortgage rates were around 4%. Now they're trending at around 6%, and that translates into a qualifying rate of around 8%. So that's sapped a lot of confidence, a lot of demand out of the market. And you can see from the chart on the right there just what's happened in a short period of time. So this is, again, a direct reflection of the markets expecting that interest rates are going to remain higher for longer, right? There's not going to be a quick transition towards interest rate cuts. And in fact, most of the economists that I follow are expecting that at some point around the middle part of next year is when you're going to start to see interest rates actually come down. And the big question mark is, how much will they come down? And most people believe you're going to see a cut of around 200 basis points to 250 basis points. So bringing the overnight rate from 5% down to a more neutral rate, which is believed to be around 2.5%. So that should translate into fixed-term mortgage rates of around 4% at some point over the next 18 months or so. But in the near term, the expectation is that inflation and interest rates will remain sticky, and this will translate into some weakness and some continued headwinds for the housing market, particularly in more expensive markets like the GTA, right? When you look at 5-year bond yields today, the average GTA home price is just under 1.1 million. The last time that we saw bond yields at this height, the average GTA home price was less than $400,000. So home prices have almost tripled since the last time we saw interest rates this high. So this has taken a big bite out of affordability, obviously. Now, I'll talk very quickly about this, but you know, it used to be sort of derided as an irrelevant indicator, the household debt to income ratio, because it didn't really matter how much debt people were taking on relative to their income because the carrying cost of that debt was low because interest rates were low. Now this indicator is starting to make more sense, right? People are starting to pay more close attention to household debt indicators because of the fact that the proportion of their income required to service that debt has risen considerably, both in terms of total debt and just interest only, rising to the highest levels that we've seen really in decades. So as this is happening, the expectation is that, you know, households will have to deleverage, right? They'll have to pay down debt, take on less credit, and that will work its way through the economy and lead to what is expected to be an orchestrated slowdown. So what the impact is on mortgages is sort of up in the air right now, but a few key points. So when you're taking a look at household debt and mortgage debt and relating that to the average household, a few key points to take into consideration in that 35% of households own without a mortgage, 28% of households own without a mortgage, 37% of households rent, 50% of mortgages have yet to reset to higher interest rates. So most of the individuals that do have mortgages have yet to feel the brunt of the impact of higher interest rates. Most fixed-term mortgage rates are going to reset over the next couple of years. They haven't done so yet. And a lot of mortgages that are on variable terms have seen constant payments, and we've seen, you know, some reports coming through the charter banks showing that upwards of 25% of these loans are negatively amortizing, meaning that the interest isn't really covering or the payments aren't even covering the interest to a degree. So 75% of mortgages are fixed payment, and 9% are really true variable. So some important stats to take into consideration as we look through the next couple of years. But this is one of my favorite charts when I'm looking at the overall health of the market. So what this shows is the percentage of household income required to service the mortgage at the average price. So it takes into consideration the current average price, a 20% down payment, 25-year AM, and whatever current interest rates are, whatever interest rates are at that point in the cycle. So it shows you that on average, 54% of household income is required to service the average mortgage at today's prices. Now, this is certainly the highest level that we've seen since 1990, and it would show you that there's some headwinds in store for the market, given how difficult homeownership affordability has become. But it also doesn't necessarily mean that we're going to see a crash in the housing market either, okay? Housing markets, particularly expensive markets and highly populated, densely populated areas, can be unaffordable for a long period of time, right? According to this metric, if you look back, the GTA housing market has been unaffordable for really the better part of the last 10 years. So this isn't a new story. What's new is just how rapid this deterioration has emerged over the last little while. So this is going to obviously take a bite out of homeownership demand, as we're seeing, and it's going to create further headwinds as we move through the next 12 months or so. How this ratio improves is through a combination of a few things. Now, obviously, lower interest rates can help to improve affordability. Rising incomes, as we've been seeing, incomes are rising 4 to 5% per year, which is great to see. But also a flattening in prices. So over time, this ratio can improve if incomes can grow at or above the rate of debt growth. So certainly this is something to pay attention to and continue to be a headwind as we move through the next while. This is a chart here that shows the 12-month moving sales total for the GTA and shows how closely it has become aligned with interest rates. So it's not only the moves in interest rates that have seen a big impact on sales volumes, but also the language around these press releases and the expectation for further interest rate moves. And you can see just how quickly the market has been gyrating every time the Bank of Canada makes their interest rate announcements. So certainly the current level of sales on a 12-month basis, which is around 65,000 units, is at a corrective level. It is considerably depressed if you take into consideration how large the population is right now. If you were to look at this on a population adjusted basis and a more normal level of activity, would actually be around 120,000 sales. So we're about half of the level that you would expect to see over the long term, given the fact that our population has been growing so quickly. So this is, by all accounts, one of the most depressed levels of sales activity that we've seen in decades, unfortunately. So it's not sustainable, right? And you can see that this relationship over time would sort of relay the fact that as interest rates move down, you would begin to see those sales activities move higher. So I think the expectation generally is that there's going to be some middle ground here. Sales activity will rise off of their bottom levels, and interest rates will begin to move lower. So we'll probably meet somewhere in the middle around there, and a more sustainable pace of sales will be somewhere around 70 to 80,000 sales, maybe a bit higher. Now, the big question mark for the market has really been on the supply side, a much more unknown. So one of the reasons why new listings and supply in general has remained fairly suppressed, I know we've seen some recent movements up in terms of listing behavior, but generally speaking, the GTA is a supply-constrained market. We've been underbuilding housing for the better part of the last 20 years, and so we haven't seen a big spike in inventory that you would normally see during this point in the housing cycle, right? Normally, demand begins to slow down, prices begin to fall, you start to see more supply come on stream. It hasn't really happened, and certainly you can see that in the 12-month rolling total for new listings for the chart on the right there. Now, distressed sales haven't really been that much of a factor. The chart on the left there shows that so long as the unemployment rate remains low, the mortgage arrears rate typically remains low as well. These two are very, very positively correlated. So there's no better predictor of the mortgage arrears rate than the unemployment rate, not interest rates, it's actually the unemployment rate. So long as people have their jobs, they will stay in their homes and they will continue to pay. Now, that doesn't say that we aren't going to see more people having to list because of financial difficulty. Certainly we will. And I think you're starting to see that pop up right now, right? It's certainly happening within the condo sector, which I'll talk about. More investors are looking to exit the market right now. We're seeing more properties that are tenanted put up for sale. Homeowners that are seeing their mortgages reset, facing huge increases in mortgage payments and deciding that they have to sell as well. That's going to continue, right? That's going to continue as more and more of these mortgages reset. So we're coming off of a very depressed level of new listings. We're going to be moving up towards a more normal level of new listings over the next 12 months. So if we see that new listings trend move back towards this longer-term trend level of around 160,000 units. We see sales improve to maybe 70 to 80,000 as interest rates begin to normalize. You're going to see a sales to new listings ratio trend in sort of the 45 to 50% range, which is kind of the bottom level of a balanced market. Certainly isn't a buyer's market, but it's not a sales to new listings ratio that's overly stimulative for housing prices either. Now, one of the reasons why I believe new listings have remained low until now is that there's been a record-wide gap between the interest rates through which new buyers are paying versus existing homeowners, right? There's not a lot of incentive to go out and move and get a new mortgage when you have to pay an interest rate that's, 200 basis points higher than what your current interest rate is, right? The best move is just to sit, especially in an uncertain market. That's going to begin to normalize as well over the next couple of years. So that's starting to a degree, but still, there's still a fairly wide gap there between the average interest rate for funds advanced and the average interest rate for funds outstanding. So how is this all impacting the market in terms of sales, new listings activity? Well, in the August total, we saw that sales fell to a 23-year low, just under 5,300 sales. That was in fact 30% below the 10-year average. I've seen some preliminary data for September suggesting that sales will probably be maybe 40% below the 10-year average. So there's not a lot of great news that's going to come out of the TREB statistics in a few weeks or a couple of weeks. The sales to new listings ratio number, I think, was even more surprising to me. So 43% was the lowest sales to new listings ratio for an August period, going back to the historical database in 1996. So normally at this time of year in August, you'd start to see market conditions firm up a little bit, right? Demand is starting to pick back up at the end of the summer. There's not a lot of listings because most people wait till after Labor Day. You start to see that sales new listings ratio historically hovered between 50, 60%. The 10-year average is 62%. 43% is considerably slow. So I think by all accounts, we've entered into what seems to be a bit of a buyer's market right now. But overall, we're not seeing a ton of distressed sales as we talked about. This is just a quick chart that shows you per capita sales and just how substantial the slowdown has been in sales activity. So on a per capita basis, we're pretty much at a historic low in terms of sales activity. So we can only really see some improvements from here. And again, if we were at a more normal level or an average level of sales per capita, we'd be twice as high in terms of sales volume. So there's a lot of suppressed demand, a lot of pent-up demand that's been accumulating in the market. As rates move down, this will start to come back in. So it's not as if the demand is evaporating in a market where the population continues to grow. That demand just sort of shifts from one side of the market to the other, and we can see what's happening to the rental market, which I'll talk about later. But these are, again, first-time buyers that are sort of awaiting to get back into the market at some point when affordability begins to improve. So looking at active listings, they are, or at least they were in August, about 5% above the 10-year average, certainly up from the levels that we were seeing over the last couple of years. Again, I've seen some preliminary stats for September that would suggest that active listings are probably going to be somewhere about 10 to 15% above the 10-year average. So that trend is going to continue to move higher. But months of supply has been reasonably well behaved. 3 months of supply is still considered to be a balanced market. I'd start to get a bit more concerned once that months of supply metric creeps up to around 4 months of supply or above. Then you're starting to really see some downward pressure on prices. I think at this level you'll see some modest price pressures, prices kind of moving in a sideways direction, but once you start to see more new listings outpace sales, you'll begin to see those inventory numbers creep higher. The market itself, still pretty liquid, right? On average, homes are selling for 100% of ask price. So certainly not where we were a few months ago, earlier in the spring when the market was getting heated again and homes were selling in multiple offer situations and the average home was selling for 105% of list price. We're back down towards that historical average. But the trend is moving down, and as you can see, as more listings kind of pop onto the market, you can probably expect that homes will start to sell below asking price. So in terms of average sale price, now this is a chart that shows the average MLS price. So there's some compositional factors in here. Now a better indicator is probably the the Korea MLS benchmark, but I don't like to look at that one too much because it fails to capture short-term movements in the market. It's very smooth, almost too smooth. So it's good to look at kind of over a longer period of time, but it's hard to capture short-term movements in the market. And I think, you know, what we see in this chart is kind of indicative of what most people have kind of been experiencing on the ground. There's been some modest downward pressure over the last couple of months, right? As more supply has arrived on the market, buyers have remained tentative. It's really put a little bit more balance into the hands of buyers to a degree. So, oops, go back. In August, we saw prices dip below 1.1 million for the first time in 6 months. Average prices decreased 3.1% month over month. Now, it's not unusual for prices to decrease between July and August. There's some seasonal effects, but that certainly was the largest month over month decline in prices that we saw going back over the last 2 decades or so. So there is some downward pressure on price that's showing up in these statistics. And interestingly now, when you look over the last couple of years, average prices are only up by a total of 1.2% over 2 years, and that compares to a 10-year average annual growth rate of 8.2%. So certainly there's been a pretty big market shift. And again, part of that is compositional. When you break down sales over the last year in August in comparison to August of last year, you can see that pretty much all of the growth has happened in the upper end of the market. Most of the activity and most of the growth happening between 1.5 and 1.9 million. So more sales happening in the upper end of the market pushes that average sale price statistic up as a result, just mathematically. So that's kind of where things look today versus last year. But more meaningfully, when you look at the month-over-month trends, there wasn't a whole lot of change between August and July when you look at the total sales stats. But when you break it down by price segment, it actually starts to show some weakness in that upper end of the market. And generally speaking, the higher end of the market is a leading indicator for the rest of the market, right? These are more discretionary purchases. People don't have to buy a $2 million home in most cases. So that starts to slow first. You start to see the rest of the market kind of follow suit. And we've seen some declines in that end of the market as well, particularly homes 1.75 to 1.99 million, down 16% on a month-over-month basis. Still a little bit of growth in the 1.5 to 1.749 million range, but really, as affordability has eroded further with increases in interest rates, we've seen more sales activity move into the bottom end of the market, right? On a month-over-month basis, we've seen homes under 700,000 actually increase 14%, and to a lesser degree for homes that are priced between 700,000 and $1 million. Breaking things down by region, we see as well some of the softer market conditions emerging for the most expensive property types. So these would be mostly characterized by central Toronto detached homes that are having a median sale price that's around $2.5 million. So we see the months of supply for detached properties in central Toronto highest, 4.5 months. Now, detached properties in central Toronto always have the highest months of supply. They're the most expensive properties. They take the longest to sell, generally speaking, smaller buyer pool. This is not totally unexpected, but it has seen an increase in inventory, certainly over the last couple of months. And that has translated into some modest downward pressure in prices as well. So central Toronto detached prices, these are median prices, have shown some slight deflation over the last year. The strongest area of the market in terms of supply has been semis, rows, and towns, still showing months of inventory across most regions of the GTA at or below 2 months, so still very tight. And you can see the year-over-year price statistics for semis, rows, and towns still showing pretty remarkable growth in most areas. When it comes to the condo apartment market, same sort of story where the more expensive units in central Toronto are seeing the highest levels of inventory and experiencing some of the downward pressure on prices when you look at it on a median price basis and on an annual basis. But interesting to see that when you look at the August figures, they were the only housing type to show some growth in sales activity. So housing sales for condo apartments were up 9% or 8% on an annual basis. And when you compare sales for condo apartments versus their 10-year average, they're actually performing relatively better than semi-rows and towns and detached properties. So not totally unexpected. As the market becomes less affordable, you start to see buyers move towards less expensive properties. The condo market is benefiting from that to a degree, so demand filtering into that side of the marketplace. But with higher levels of listings, and you can see from the bullet point there at the bottom, condos did see the strongest growth in new listings in August, and that's a trend that continued in September. 24% year-over-year growth, that is putting some downward pressure on prices. So average prices were down 0.9% year-over-year for condo apartments. They were up on an annual basis for all other property types. But if you compare condo prices today versus where they were at their peak in the February of 2022 period, condo apartments have held up best as well. So there hasn't been that as much volatility in condo prices as there has been for detached and semi-rows and towns, which have seen prices off by 18 to 21% from their February peak. So again, going back to the supply side of the market, with condos being a little bit better supplied than some of these other areas of the marketplace. Drilling into the condo market, going back to my earlier point about some softness in prices in the city of Toronto, we actually have seen prices in the 416 down by about 8% in the past 3 months. We saw a month-over-month decrease in the 416 of around 4%. The 905.2 generally has been holding up better, but we did see a bit of a decrease in 905 area average prices for condos. But if you look at things on an annual basis, condo prices in the 416 are down by about 2%, while 905 prices are up by about 1.5%. So the GTA condo market hasn't seen as much of a downward trend in prices from the February peak, but are starting to see some softness over the last few months. So certainly not immune to what's happening to interest rates, as the bottom bullet there shows. Condo prices are up by less than 3% in the last 2 years, which has obviously helped affordability to a degree. But if you can take into consideration interest rates moving from 2% to 6% over that period of time, the average mortgage payment associated with buying the average price condo is up 55% to over $3,600 a month. So we talk about how expensive the rental market is. Well, it's still relatively more affordable when you look at the entry point for buying the average price condo. That doesn't even factor in condo fees, which are now averaging over 70 cents a square foot, property taxes pushing you well over $4,000 a month, just in terms of getting into the market at this point. So it's become very difficult even for entry-level priced units in today's housing market. So this is a chart that shows the difference between the average price of a detached home and an average price of a condo over time. And generally speaking, as that gap grows, you start to see an increased share of sales activity move into the condo segment. And that's sort of something that we're starting to see again. So as the gap narrowed between 2016 and 2020, you started to see a decreasing share of sales going into the condo sector, right? The market became more affordable as interest rates decreased, and you started to see people buying up into the market. And so condos took on less prominence within the market over that period of time. But ever since interest rates have moved up and prices have skyrocketed, that gap has grown. Now, it's not quite as high as what it was in 2021, but still at an average gap of over 700,000. You can see that that's translating into an increasing share of sales going towards the condo segment. So we're moving back up to highs of around 30%, and the expectation is that that's going to continue to grow over the next couple of years just due to affordability constraints. Now, talking about the condo market, talking about demand, I think is incredibly important. Certainly condos are the driver of new home development in the GTA. But if you look at overall housing completions, overall housing supply in the GTA, we're well below every other major market in Canada, right? So we've been building at the same pace as we have been for the last 20 years. Meanwhile, the population has soared. So when you look at per capita housing completions, we're well below markets like Montreal, Vancouver, Edmonton, and Calgary. And this is happening despite the fact that condos, which are obviously the dominant form of new housing construction, represent 60%, more than 60% of overall housing starts in the GTA right now. So condos are doing all the heavy lifting as it comes to new housing supply, but as this chart shows, it hasn't been enough to keep pace with population growth. This chart shows it even more clearly. So the light blue line there shows the total population increase on an annual basis. The latest available data for the GTA was for 2022, showing you that the population increased by nearly 140,000 people in 1 year. Compare that to the amount of construction that's been happening in the GTA, right? We've been pretty much stuck at 40 to 45,000 housing starts for 20 years. We're not building at a pace to satisfy demographic demand. At that level of population growth, we should be building somewhere between 55 and 70,000 housing units a year just to keep pace with the population. So we're well below that, and this is continuing to lead to housing supply deficits, right? I don't think there's been a week that's gone by over the last year where there hasn't been a study released on how big the housing supply deficit is in Canada. Well, it's probably most acute in markets like the GTA, where you're seeing the population rise to record highs and housing construction continue to lag. So I think this can explain a lot between what's happening to housing prices and population growth. And there's been some studies that have been done, and unsurprisingly, population growth and home prices are linked, right? Over time, over a long period of time, the markets across the globe that experience the highest rates of population growth generally have the highest home prices. They see the strongest rates of housing price growth. So it's interesting to note that just simple population growth over time, not in the immediate term, but over the medium and longer term, can explain a lot between what happens to housing prices, right? This isn't just a GTA story, as you can see. This is happening in other parts of the world as well. But I guess the point here is that this mismatch between population growth and housing construction inevitably will put upward pressure on housing prices. It may not happen in the near term due to what's happened to interest rates and affordability, but over the medium and longer term, you can be confident that there's been enough work done in this space to suggest that there is going to be, long-term upward growth in housing prices due to how much of a mismatch there is between demand and supply. Now, transitioning over to the condo market, I just want to put up a few quick stats on where we are right now. So we have a built housing stock of condos in the GTA that has reached 425,000 units. In a few years, we're going to be at 500,000 units. That's how big the condo market is right now. 50% of the entire stock was built since 2010. So we're still a relatively new market. Almost 40% of all of those units that have been built are used as rental properties. And I think that's a surprising stat, particularly people in the US that come here and they're trying to understand what's happening in the GTA housing market. And the fact that we don't really build purpose-built rentals and the condo market has become our de facto supplier of new rentals is surprising to many. And in fact, when you look at recently completed buildings, this is data that's come through in the census, nearly 60% of those units are rented. So investors are integral to the home building process in the GTA. Housing starts of GTA housing starts have a 60% share of condos over the last 5 years, so again, representing the majority of new home development. And we now have about 103,000 condos under construction across the region. So that stock is going to quickly grow above 500,000 units in the next few years. So, it's important to pay attention to when we're thinking about the condo market and where it's going to go in the next few years in terms of supply, because there are a record number of units still under construction that need to come to completion. With that said, though, we can see early signs of the development process slowing down, right? If you looked at housing construction starts, it's not going to tell you what's happening at the ground level in terms of pre-sales, okay? We released our second quarter stats a couple of months ago. It showed that new condo sales are down nearly 60% annually in the first half of 2023. They're 42% below the 10-year average. It was the slowest first half in 10 years. And that's not going to get any better. I can tell you the Q3 stats aren't going to look great either. There hasn't been much new launch activity, and absorption has been slow. We're well below average, and this tells you that there's going to be an impact on construction. Usually there's about a 12 to 18 month lag. As new condo sales slow, construction begins to inevitably slow, and then 5 to 6 years down the line, completions begin to slow, okay? So we're seeing this happen at the early stages. And it's happening at the exact wrong time, as you can see from the chart on the right there. What that chart shows is the 12-month moving total for new condo sales versus population growth. So 12-month moving new condo sales have dropped to only 12,000 units. It's the lowest level since 2009. In order to keep up with population growth, we should be selling at least 30,000 condo units a year, at least consistently. We're less than half of that. So there's going to be some supply problems down the line, definitely. The question is, how long is this going to persist, right? We know that new launch activity is starting to pick up. I'll talk about that in the next few slides. We've seen some new projects come out. How are they going to sell, right? Everyone's paying attention to these projects to see the absorption and whether or not the confidence has improved and whether or not we're going to see more new launches and that feed into new condo sales and new construction. As you can see from the chart on the left here, new launch activity has been pretty slow. And absorption within that inventory has been slow as well. So, in 2020, 2021, early part of 2022, we were launching a lot of units and they were selling quickly, right? New launches were getting absorbed. 80% of the units were being sold within the first couple of months after launch. That has since moved down to 50% or lower. But you can see that most of that absorption is happening at below market prices, right? Almost all of the absorption is happening at $1,300 a square foot or less. The average price per square foot of a new condo is above $1,400 a square foot. The market for condos above $1,400 a square foot has shrunk considerably. The market's still there. It has moved meaningfully into sort of the $1,200 a square foot range. This is how kind of buyers have adjusted to the slowdown. As you can see, the average price per square foot, $1,411, that's starting to move down gradually, but it doesn't really tell you the whole story. Now, certainly part of that story is the increase in unsold inventory. Unsold inventory is at its highest levels in about 7 to 8 years. But I've been kind of encouraged by the fact that some of the new launches that have come up more recently are coming out at pretty aggressive prices, which I think are going to spur new sales, right? Developers are adjusting to the new market reality that the market has slowed, and they're going to be required to be more competitive on price, right? This is a list of everything that's been launched so far in September. There's more that's being added. There's more projects that are being announced. But generally speaking, you can see that most projects are priced below $1,200 a square foot, at or below $1,200 a square foot. Now, there's some exceptions. Park Road, which is just on the border of Bloor Yorkville, just above $1,600 a square foot. But if that project launched in early 2022, it would have been $2,000 a square foot, easily, okay? So they're coming out more aggressive. Developers are coming out at a price point that they know is going to attract absorption. And I can tell you, a lot of these launches, based on preliminary sales, Pickering City Center is 85–90% sold at just over $1,000 a square foot. It's attracting demand at a certain price point. As well, buyers are gravitating towards less expensive markets in the GTA. So nearly half of all new condo sales now are happening in the 905 region of the GTA, where the average price is 30% less than the average price in downtown Toronto. Okay, so this is a big shift for the marketplace. Not long ago, we were seeing that the former city of Toronto, which is again largely representing the downtown market, represented the majority of new condo sales. Now they're less than 1/3 of all overall new condo sales as buyers shift more and more towards markets where the average price is $1,200 a square foot or less. This shows very clearly how much the markets shift in terms of the top 10 selling new projects. So in the second quarter of 2022, the top 10 projects averaged about $1,430 a square foot in terms of their average sale price. The top 10 projects in the second quarter of 2023 averaged less than $1,200 a square foot. So, when you see new condo price per square foot statistics released and they show, a 1% decrease, it's not telling you the whole story for sure, right? There's definitely been a movement in the market and a movement in demand towards lower price product. Now, as this has happened, it's actually interestingly starting to close the gap between what's happened in terms of pre-sale prices and what's happened in terms of resale prices, right? One of the bigger stories over the last few years has been how big this gap has gotten between new construction prices and resale prices. But again, as buyers move towards lower price product, it's actually shrinking that gap to a degree, right? In the second quarter, it was 38%. A few quarters ago, it was 67%. So they're realizing that the resale market is adjusted as well. And in order for these investments to make economic sense, they need to buy at a price per square foot that's closer to the resale comparables. Now, that's an average price per square foot for the entire resale market. If you were to look at newer buildings, I think you'd find that the average price per square foot is probably around $1,000 a square foot, $1,050, maybe $1,100 in some cases. So that gap narrows depending on where you go. But it's more sort of the movement in that gap over time that's showing you how investors are starting to pay attention to what's happening in terms of that price gap. Now, that's not doing them a ton of favors in terms of the carrying cost because of how high interest rates have gotten. So what that chart shows is the math on the average ownership carrying cost per square foot for a new launch. So basically, if you bought at the average price per square foot for a new launch, at whatever interest rate is prevailing at that time, what would be the rent required to cover all your carrying costs with some of these assumptions here, with a 20% down payment, 30-year AM, and including condo fees and property taxes. So if you're buying at just under $1,300 a square foot, you're going to need an average rent of almost $7 a square foot. The average rent per square foot in the market is $4 a square foot. So there's a gap there as well, and that's why you're starting to see more developers roll out things like rental guarantees, right, that are showing you that you can actually generate some neutral cash flow. Another thing that's kind of helping the market to a degree is the fact that it's taking longer and longer for projects to reach completion. So we pulled up some stats on projects that were reaching occupancy in the second quarter of 2023. In fact, we looked at all projects that reached completion during the previous 12 months. What we found was that the time between launch and completion was nearly 60 months. 5 years, sorry, there's an error there in the title, it should be 5 years. So that is moving up. You can see every year we add another month there. So it's taking longer and longer for projects to reach completion. Part of the reason here is just the supply pipeline has gotten so heavy, right? We've learned that we can sell upwards of 30,000 new condos a year. We can start construction on 27 or 28,000 new condos a year. We can't deliver more than 20,000 condos a year, right? The industry is stuck in terms of capacity delivering new units. We were expecting, I think at the beginning of this year, we were expecting that there was going to be 30,000 completions for 2023, upwards of 30,000 completions. And every month as we look at the completion schedules for these projects, we have to continue to delay them into 2024, right? We'll probably reach, I don't know, maybe 20,000 completions this year if we get lucky, but still well below what the level of construction starts is, and again, leading to some supply bottlenecks when you look at the number of units under construction. So in terms of incentives, another way that developers have become more competitive is offering more incentives, right? So behind the scenes of all of these price statistics are incentives that are intended to move the product. So the baseline incentive package before interest rate increases came about were no assignment fees, they were pretty common, capped development levies, extended deposit payment schedules, and then typically you'd see a 4% broker commission. Now we're seeing that plus reduced caps, zero development levies, we're seeing cash back at closing, no maintenance fees, rental guarantees for a significant period of time at significant rents, reduced or free parking and lockers, mortgage rate buy-downs. I've seen developers offering mortgage rates at 2.99 for 2 years after closing. That's pretty significant. And then 5% or even higher broker commissions. So there's a lot going on behind the scenes to move new condos right now. I'm going to talk quickly through some of our research that we did on condo investors. This was for data that was compiled for 2022. So we've done this study a few times over the last several years, and basically what we seek to do is look at all of the newly completed condos that came into a market in a given year, and then try to calculate what their cash flow is. So we give the data on closing prices and rents to TerraNet, who matches all that data up with their mortgage information. And then we know what the condo fees are and the property taxes and things like that. So what we found was most investors buy new condos, unsurprisingly. Of all the units that were closed in 2022, 72% were newly completed condos versus less than 30% that were resale units. And then out of those newly completed condos, what we found was that for the first time since we did the analysis, the majority of newly completed condos were cash flow negative. So most people that buy resale units are cash flow negative, so we can see only 18% of those that bought resale units were cash flow positive, which wasn't that much different from 2021. It's difficult to buy a unit and rent it in the same market. Usually, people will buy pre-construction, wait for rents to appreciate over the course of the construction cycle, and then rents rise to a level that will cover your carrying costs. That worked like a charm for 15 years until it didn't, right? And that happened in 2022. We can see that the average cash flow turned negative for resale condos and for new sale condos as well. Less than 50% of all newly completed condos were cash flow positive. So that was the first time that it moved below the 50% level since we did this study over the last 5 to 8 years. And you can see what the difference there is in terms of the average rent versus the average ownership carrying cost. So it certainly wasn't due to a lack of growth in rent. As we can see, rents have been rising very quickly. It was really the sharp increase in average ownership costs directly related to mortgage interest rates. And take in consideration, this is an average for all of 2022, so it doesn't fully account for the full increase in interest rates that have happened. And I can tell you that looking at some preliminary data for 2023, that cash flow position has gotten worse. It's going to get worse next year. It's going to get worse the year after that. The reason why is because we're going to be seeing more and more higher priced condos that were bought in recent years come to completion in a higher interest rate environment. This is just showing you the average cash flow position for newly completed condos, over $200 a month, whereas in the previous few years we were seeing some modest positive cash flow, and then that's the distribution between cash flow negative and cash flow positive newly completed condos. But going back to my earlier point, this negative cash flow occurred despite the fact that the projects that were reaching completion in 2022 were largely purchased as pre-sales in 2017 and 2018 at much lower prices than today. That price growth is still under construction, okay? So these condos have yet to reach occupancy. And you can see what's happened since that price inflation really took off for new condos. It started to diverge from resale condo prices, particularly since interest rates moved up, and as well the rental market, right? We talk a lot about how quickly rents have been rising recently, but a lot of it is catch up from COVID, right? There's still a very big dislocation here between what's happened to new condo prices and rents, and this is going to be problematic for the market over the next while. Now, I'm bullish as the next guy in the rental market. I think the rental market is severely undersupplied. I think we have a massive rental supply deficit in the GTA that's only going to continue to get larger and larger. We hear about, you know, the student housing crisis, the lack of purpose-built rentals, the rent inflation that we've been seeing, but I can tell you rents cannot grow by 10% every year. The market will not afford it. People will leave the city. We're starting to see it already, okay? People double up, they get roommates, but at a certain point, you begin to see larger and larger net outflows of the city to more affordable parts. And I can tell you, based on some of this data that I'm seeing, we're starting to reach some resistance levels in the market as well. As average condo rents have reached basically $3,000 a month, that rate of growth on an annual basis is starting to calm down. Okay, the August data showed that average rent increases at 5.3% were the slowest pace in 2 years, okay? So it's not like we're continuing to see 10 to 15% growth in rents anymore. I think we're gonna start to see some leveling off, right? Part of that's gonna be due to base effects. We're already comparing ourselves to record high rent levels, but as well, incomes just aren't keeping pace with that level of rent growth as well. Now, more recently, and I'm sure Ted will talk about this, the government has announced that new rental construction will no longer be subject to GST, and then it's expected that the province will take away the HST, the PST component of HST as well, and that is expected to spur new rental construction. Now, I don't think this is a game changer, to be honest with you. And really, if you go back to what's happened in terms of rents and construction costs, that's painted a pretty clear picture. Even before interest rates increased, it was difficult to make the math work on a purpose-built rental project. And as you can see over the past 3 years, construction costs have increased 2.5 times more than rents, okay? So this is without the increase in interest rates and without the increase in development charges. And I've talked to a lot of rental developers and they say, yeah, this is good, but the increase in DCs that I'm experiencing this year is going to eat up 60% of that rebate in GST. So it should help to a degree. It's a good first step. It's a great first step. But it is not a game changer in terms of bringing in a massive amount of purpose-built rental construction. It just isn't. It may put us back on course to where we were prior to interest rate increases, but that was a level that was grossly insufficient for demand, right? You can see what's happened since these two lines have diverged. Rental construction in Toronto has basically flattened out. Rental construction starts have decreased. I can tell you that I have seen more requests for purpose-built rental feasibility studies since the GST announcement was made. But it's not as if developers are all of a sudden going to flood into the market and start building rental construction. It will happen in time, but I think more needs to be done from a policy standpoint to encourage rentals. That's really an important step towards tackling the affordability crisis in the GTA. Because according to our projections, rental supply and the rental supply deficit in the GTA is going to double over the next decade. So what we did is we projected rental demand over the next 10 years. We projected the increase in rental supply under a pretty optimistic scenario for rental construction, and as well, the rentals that we are expected to see from condominium investors. And that gap is going to basically rise from around less than 90,000 units to nearly 180,000 units in the next 10 years. So there's not a lot that they can do about this, unfortunately. It takes 8 years on average for a project to go from application submission to actually getting built. 8 years. So what's already in the system is pretty much baked in the cake. We know what supply is going to be over the next 10 years and is going to be nowhere near the level that we need to satisfy demand, unfortunately. So The outlook, given this, is continued downward pressure on vacancy rates, right? We have a vacancy rate in the city of Toronto, it's about 1%, it's not going to change. We have rents that are reaching new highs. They're probably not going to continue to rise again as quickly as what we've seen in previous months where they were seeing, 10 to 15 to 20% year-over-year increases. But we probably can expect to see 5% growth a year in rents, okay? That's not enough to cover costs for condo investors, unfortunately. I think there's going to be some challenging times ahead for investors who bought at peak prices and are going to see their units come up for completion over the next couple of years. It may be the case that these units aren't worth what they were paid, and it may be the case that the units have a significant negative cash flow situation. So in that sense, the assignment market is likely to continue to grow. I don't have any official stats on the assignment market, unfortunately, but anecdotally, it's big, and it doesn't seem, at least at this point, to be having a broader impact on the resale market, but it is happening at the fringe, and I think you're going to see some challenging times ahead. Over the long term, I think we all know, given the correlation between housing price growth and population growth, that there's a lot of positive things to say, but there's going to be some challenging periods, and a lot of this goes back to those dislocations that we saw when interest rates were at rock bottom levels. So I think the rental market certainly is an area that's going to see some growth for sure, but I don't think the supply is going to be there to be able to satisfy the level of demand. I'm probably running late. I will take out any questions that you guys have at this point. Yeah.
The mic, there we go. Thank you so much, Sean. Any questions? Yeah.
In terms of which, like new condo sales? Well, a lot of the stats come through TREB, so I couldn't speak to the error of margin on TREB. I know there are revisions as some sales fall through, so I would say it's probably very close to 100%. In terms of new condo sales, we do get direct reporting from developers. Now, there's an incentive for a developer to lie and tell us that they're doing better than they actually are. But we don't just take the word of a developer or a sales agent that's representing a developer. We talk to multiple sources to try to get behind what the actual sales data is. I've actually been pleasantly surprised that during this downturn, developers have been pretty forthright with giving us even poor results, saying, look, we're not selling well. We launched this project and we're 10% sold or 15% sold. And we'll talk to a bunch of agents and say, what are you seeing? Are you seeing the same sort of thing? So we do vet the data. Now, when you're relying on a survey, it's never 100% accurate, but I would say it's very close.
Thank you. Larry, and then Tim.
Yeah, the one question I have is, I mean, the stats were great, thank you for all that, but I didn't see any reference to the land transfer tax impact, especially for GTA.
So the additional tax above $3 million. Yeah, we haven't done the analysis on that yet, but I would say that if anything, it's going to really restrict supply.
Yeah, thank you. I'll talk on that a little bit too. Tim, I like your name.
This is more of a selfish question, but it's related to the HPI. Do you know why they changed the HPI numbers?
I don't. I bet Ted does. Yeah, the question was around the HPI. I'm sure you know more than I do in the background about.
How do you get 50% of the properties that are positive cash flow? I don't understand
How did 50% become positive cash flow? Because they were bought at an average price of around $700 to $800 a square foot.
And even if you add, do you add in property tax,
Yeah.
insurance, condo fees, and they still come up positive?
Just because they were bought at prices that are, so much less than where they are today. Well, you'd be surprised. I mean, I'm sure you know. 20% down. Yeah, 20% down, 30-year AM. Yeah. Most condos, so most new condos do close at an 80% LTV. Right. Yeah. Like right on average at 80%. Well, that was looking backwards at 2022, so it captures the first part of the year when we didn't see a whole lot of interest rate increase. That share, if you looked at it for the first half of 2023, would be quite a bit less than 50%.
A bit less. So that would be less. Yeah. Thank you. Any other questions? Oh, one more question.
can reasonable and expected from those announcements?
Want to try one more time? Here's some
Yeah.
announcements.
Yeah, recently there's a lot of announcement from the government, both the federal and provincial government, regarding to building new houses, right? What kind of impact you can see from those announcements?
So I addressed the HST. I think it'll help, but I don't think it's going to satisfy the level of demand. You know, the upzoning, it's going to help around the margins as well. Honestly, I think in order to really close the gap, we need massive upzoning, not incremental upzoning. We need to upzone significantly everywhere, particularly in urban centers, particularly around transit. But just moving things up a few stories is not going to change things, at least over the next 10 years.
But we'll cover that too. Like I have some slides on that.
You have some slides on that, yeah.
So I'll help with that.
Sure.
No problem. All right.
Okay, thanks everyone.
Hey, thanks a lot, eh? I want to thank Sean for being here and sharing those insights. It's always great. I'm also excited to announce that we've actually signed an agreement. Gentlemen, we've also signed an agreement with Urbanation, so we're going to have all the stats in-house. We'll be able to, provide you access to floor plans or different stats as they're coming along. So that will be, it's already been signed and it's imminent to come through right away, okay? All you got to do is reach out to marketing at RE/MAX Ultimate. We're just setting up their email access point so that you can get any metrics you want from any of the stats that we shared today as well, okay? Our next speaker, we are running behind, so I want to get our next speaker up here as soon as possible so we're going to have a conversation about policies. And it's Ted Tsiakopoulos, is a senior economist and sought-after speaker with many years of experience analyzing real estate and financial markets. In 2019, he joined CMHC's Housing Markets Policy Team and helped lead a modeling project geared to addressing structural barriers in the Canadian housing market. Prior to joining the policy division, Ted provided functional guidance as a team of economists responsible for economic and housing analysis, as well as research. Over his professional career, his commentary and research has been widely quoted across major media outlets as Money Magazine, BNN, CTV, and CBC. And Ted devotes significant personal time to education, having served as a consultant to Junior Achievement of Canada. He's also a part-time lecturer of housing economics at Toronto Metropolitan University, formerly Ryerson. And in 2020, he co-authored a book called Property Trendsetters, highlighting how Gen Z needs to prepare for the economic and real estate disruptions that are coming. Ted is currently on the board of directors for the Toronto Association for Business Economics. Ted obtained a master's degree in economics from York and also studied at the London School of Economics in the UK. And I just wanted to add that Ted's opinions are those of Ted's alone and do not represent CMHC. It's very important that I add that little comment because a lot of conversations are going to happen right here. We don't want to tie everybody together. Ted, welcome to our office AGM. So we're going to do a little bit of a different kind of presentation right now. It's going to be more of a question and answer period. Ted and I worked on putting together some good questions that will talk about both the macro and the micro of what's happening, and more specifically towards what disruptions we're going to see as well, right? And what to watch out for moving forward. So I'm not sure if you're aware of this, but Ted and I actually co-authored a book called Trendsetters. And it hit a bestseller back in 2020. We did it during the time of COVID. I haven't really advertised it. I was just happy to be part of it, and it was really something that was, great, where we built more of a relationship together. Let's talk about disruptions that are coming and how the next generation needs to manage these. To set the context, Ted, could you reflect on historical data and very briefly highlight what were the factors that contributed to the current affordability crisis?
Okay, thank you very much. My mic's on, I think.
It's on. Yeah, perfect. I can hear you.
So thank you to Tim and RE/MAX and for all of you for taking the time, I guess, to be here today. I really appreciate it. So we all know what's happened on the house price front in the last decade. We know what's happened regarding affordability. It's eroded dramatically. What were the factors driving the story? Sean did a great job talking about supply. I'm going to put some numbers to this. supply has probably explained 2/3 of the run-up, the lack of supply, 2/3 of the run-up in house prices that we've seen over the past decade. And the supply that we need to help restore affordability by 2030 is massive. It's huge, okay? What are we talking about here? Well, I've circled here how much new housing we need across the country. We need about 3.5 million new homes nationally. By the way, that's over and above what we're actually building today. So it amounts to a doubling of housing construction on an annual basis. Massive, massive number, right? Half of that supply gap is in the province of Ontario. So we're looking at something in the order of, 1.5 million homes needed by 2030 in Ontario. And half of that number is in the Greater Toronto Area. Now, we haven't published the official numbers at a city level. Look out for that in the months ahead. But we've got a massive job ahead of us to help restore affordability. Now, if you believe that the problem is supply exclusively, it isn't. 1/3 of the run-up in house prices was also caused by rising population growth, low interest rates, and employment growth, okay? 1/3. It's not, I remember, Tim, you saying, well, 1/3 isn't 1%, it's not 5%, so maybe we shouldn't turn a blind eye to the demand side. So demand has played a role here, and we'll talk about, how and why. The final thing is governments haven't been coordinated. I'm going to be quite frank. We haven't been coordinated. We haven't collaborated. We haven't worked together to solve this problem that's been brewing for a long, long time. And we'll get into why coordination and collaboration is so important. What happens when you don't have that? Disaster breaks. That disaster, you're facing disaster. I'll show you a great example as we move along. Yeah. So I should have forwarded the slide. Now, why was demand a factor? So we heard a lot about, excess demand in the broader economy pushing CPI inflation higher. But here's what it looked like in housing. So you see this picture here. It has nothing to do with supply. Just looking at what was actual demand in the marketplace in the province of Ontario back in 2021. And it's that red broken line. And where should have demand been given fundamentals, given where interest rates were, employment growth, population growth? You can see we built a 20% excess demand in that marketplace. This wasn't in 2022, ladies and gentlemen. This was in 2021. The writing was on the wall as early as 2021. So if you believe that it was just a supply story, think again. There was demand pressures brewing here. There was excess demand in the housing space. Yeah. So before we get into that, yeah. Okay.
Do you want me to talk about the immigration here?
I think there's a question you're going to probably ask.
Go
me.
ahead. It's okay. Yeah.
Yeah.
Can you continue?
I was going to stop there.
I got you. Okay. So no problem. So because there's the macro question we have here, right? Because I'm looking at the TV screen from the backside.
No worries.
Let's dive into the macro and micro policies in more detail, and let's start with monetary policy, right? So the question we have here is how accommodative has monetary policy been historically, and what could have been done differently?
That's a loaded question, and I'm glad we had that disclaimer up front. So we learned a lot through the pandemic, right? We learned that fiscal policy works, and it actually works quite well. What do I mean by that? Income support programs were probably sufficient, right, sir? More than enough to deal with the pandemic that we saw. But then we said, okay, let's layer on another layer of stimulus. Let's push interest rates down to 0, right? And then let's add another layer of stimulus with quantitative easing. How many people know what quantitative easing is? Yeah, so you're basically printing some money and you're basically buying some bonds in the open market, government bonds, corporate bonds. That's adding even more cash into the system, more liquidity. So I'm going to use the analogy of a patient that's admitted to the emergency room. A patient was the economy. Pandemic was an emergency situation. We needed to act. We needed a policy change. We needed more stimulus. We got it. but we probably injected the patient with too much medication. And you know, you want to address the side effects of that medication in a timely way. We didn't. We were all looking at the same data, right? By the fall of 2021, the broader Canadian economy was overheating. Inflation was starting to accelerate. I showed you the housing numbers here. This was fall 2021, right? So the writing was on the wall that something had to happen, had to give, right? We didn't see action. Interest rates weren't hiked in the fall of 2021. In the next meeting of the Bank of Canada in March of 2022, we didn't see a hike. Very problematic for me because we know that when you hike interest rates to cool the economy down and bring inflation down, it doesn't affect the economy in real time. It takes 4 to 6 quarters later before you actually bring inflation back where you want it. So if the economy was heating up by the fall of 2021, that meant that you wouldn't see that effect until 4 to 6 quarters later. So we didn't act fast enough. And I think that was a
Yeah, so basically, you know, when you're looking at what was going on through the actual pandemic, you know, everybody was at home, right? Everybody's working with their pajamas on. People were actually, like the whole world changed on a dime. What used to work in 1990, because we had this discussion, what used to work in 1990 is not going to work anymore in 2021 or 2022 or 2024 and going forward. It's impossible. Because this device right here is a walking computer on my hand. It's a very, very different e-commerce environment. So slowing the economy down as they said they would over a period of time, don't worry about interest rates, was no longer an option. It had to happen fast and heavy to slow people down. And even that didn't happen. Even that didn't help. Because now I'm sitting at home, not worrying about interest rates, sponsored ad comes on, and I just keep on buying stuff because I have all this excess money, right? And if I compare, because we talked about, if you don't mind, right?
Yeah, no.
And if I compare the Canadian market to the US market, it's very, very different. The US market allows you to have a 20, 30-year fixed rate. Imagine that, a 20-year fixed rate. Imagine if we had a 30-year fixed rate at 2%. Where would you spend your money now? In the market. You would still buy cars, still buy clothes, you would still renovate. Am I wrong? But now when you have a variable environment that's increasing, and by the way, we have 3 mortgages that are variable. I refuse to lock in. But you know, again, this is like to give you insight. I used the low interest rates in my life to pay down debt. I didn't use the low interest rates in my life to add more debt. See the difference? And the majority of consumers in Canada did not do that. They just piled on debt. Like it was a drunken sailor or a train with no brakes on, right? I don't want to go with immigration right now, but
again, if we had reacted to those side effects quicker, right? If we had looked at the data and made a call quicker, hiked rates quicker than what we did, then we probably wouldn't have had to slam the brakes on as hard as we have. In other words, we probably wouldn't have seen the overnight rate at 5%, probably something below that. Most likely, half a point, maybe 1 point below that.
But you have to add what's going on around the housing market, is what I'm saying to you, right?
Yeah.
You can't just we can no longer just look at the housing market in itself anymore, even though in my slides after this conversation, you'll see I have all the eyes on this market. You know, we can't just look at it. We have to look at what's affecting the consumer behavior.
Yeah.
Right?
No, absolutely.
Sorry, Ted.
Absolutely. No. I think I'm done on that one.
Where are interest rates likely headed and why? And then the next question that we have is a lot has been written on the decline in GDP, income per capita. What has contributed to this decline and why does it need to reverse? Why is this important to realtors selling homes?
So before we get to the GDP per capita story, let's talk about interest rates here. Most of you may have caught the Federal Reserve's testimony a few weeks ago. What stood out to me was they don't see inflation getting back to their 2% target until 2026. So they've pushed that out a bit more. There's a subtle message there that they believe inflation will remain sticky on the way down. And they've also hinted that we're going to probably see one more hike at a minimum. Now, Canadian policy, monetary policy, follows US policy, as you know, very closely. So what are the three reasons why I believe interest rates are certainly headed higher, okay? The first is, something that's beyond the control of central banks. And I wrote a little bit about this in the book, and these geopolitical tensions have led to not just polarized political environment on a global scale, it's spilled into the trading world. So now we've got trading blocks evolving, right? So that globalization that we've known for some time, for decades, has shifted, right? What does it mean at the end of the day for inflation and interest rates? Well, it means that if you're a manufacturer or a producer and you're sourcing your raw materials from the most cost-efficient producer globally, you're not doing that anymore because the pandemic hit or because there are costs of doing so when the United States of America says, we don't want you trading with China. So you're sourcing your raw materials from a less cost-efficient producer. That means your cost curve automatically shifts up. It means you're passing some of that increasing cost onto the end consumer. It means that inflation is probably higher than what it would have otherwise been. Monetary policy cannot restrain global inflation. It can only restrain domestic inflation. So this is a world that we're going to be in. This deglobalization is not going away. That's one reason why I think inflation will remain sticky in the short to medium term. The new normal is inflation above 2%. A second reason why I think we're going to see rates moving up is the consensus out there is we're not going to see a significant contraction in the Canadian economy. It's going to be more milder than what we've seen historically. Lots of uncertainty around that perspective. I'm in that same camp, but if that does come true, then that means that the economy is not building enough slack, which means it's not building enough excess supply to help restrain inflation. It means it's staying too resilient, right? And that's what we've seen. Now, we have seen a contraction in GDP in the second quarter, very mild. So if that's the story we see, inflation's not going to get back to 2% quick enough, okay? So
I don't even buy that it's ever going to get to 2%, to be honest with you.
Yeah, it's going to take...
I think that's just conversation, just the same conversation they said that, rates will not increase for 2 years. Is the same conversation, I think, that, we're going to have a target inflation rate of 2%. Because what I said earlier is what I deeply in my soul believe in. E-commerce, AI, which we'll talk about later, but possibly right now, I'm not sure if you have that, just what's happening at the speed it's happening, I just don't see a 2% inflation.
Yeah, so I think AI and robotics, Tim, I think will probably, that effect will kick in longer term and will probably help restrain inflation. But in the short to medium term, we're looking at 3% inflation. We're not looking at 2% inflation. That means that banks will still be on alert, right? Rates will stay higher for longer. Now, here's the final factor, and I don't know, and I posted this on LinkedIn, and you may find this interesting here. So what I'm plotting here in orange is the long-term 10-year bond yield in the United States. You could see I've plotted a trend line through that orange line. That's a long-term trend line, and that trend line is moving north, ladies and gentlemen. We haven't broken that. And then in purple, or what is that? Burgundy, or?
It's your color, I don't know.
Burgundy is oil prices, okay? And you could see oil prices have trended down over the past year, but look what's happened here. Unlike long-term bond yields, oil prices have broken that downtrend, okay? And traders, or people who are trained to read technical charts, and I've trained my eye to read technical charts, is when you break that downtrend, you're moving up, and you're not stopping until you hit the next resistance levels. Well, the next resistance levels for oil is at $95 to $100 a barrel. That's the next, speed bump. So until then, we're moving north. And you can see over time what how tight of a fit between bond yields and oil prices. They move in similar directions. We have seen that divergence in the last year, but we have to close the gap. And what I'm arguing here is we're not going to close the gap with the 10-year yield moving south, because there's no evidence it's moving south. In fact, this thing is trending high. We are closing the gap with oil prices moving up. And that means that central banks, their hand will be pushed to deal with this problem, that we probably will see a reignition of inflation, and we already saw it in August, and I think Sean made mention of that. We saw inflation picking up. So that's another factor why I think that we will see further hikes in the U.S. and in Canada, moving forward. Now, the GDP per capita, what's happening there? Why is that so important? That's been moving in the wrong direction, unfortunately.
Is there anything working in the right direction?
GDP, the numerator has been doing pretty good. We've been growing, right? We've been resilient. GDP has been growing very well, right? The problem is a better measure of how well we're doing is how much of that is being distributed across the population. Now, why should realtors care about this? Why is this important? Well, if GDP per capita is growing, it means it's being distributed across the population. That's more purchasing power. That's more capacity to buy housing and other goods and services. You don't want income growth to be just exclusively focused on upper income or lower income or middle income. You want it distributed, right? So that's why that's so important. So why has it been moving south? Because we have not made progress on the productivity front. Our productivity performance has been abysmal in Canada. It's been trending down. Now, that's not good. We need to reverse that, and we need to reverse that immediately. Because we're a small economy, but we're open. We're an open economy, we trade. We're a more open economy than the US. Trade matters for Canada. A quarter of our GDP is driven by exports. Half of that, 12% in the US of GDP is driven by exports. We're a more open economy than the US, so we need to be productive. We're not. The only way that we're going to move that GDP per capita north is if we incentivize more productivity enhancing investments, okay? We haven't done that, and we need that to change and change immediately. We need to reverse course immediately.
So how would an increase in work productivity contribute to less need for more immigration and better housing affordability outcomes?
So I know that's a mouthful, right? But think about this. To produce one product or to deliver a service, normally a entrepreneur needs capital and labor to do this, right? In Canada, we've lost our way. We have not found that sweet spot, that balance, that capital-labor ratio, that nice balance. In fact, our capital-labor ratios in most sectors of the economy is too low. Why? Because we've gotten too fat on the labor side, right? So what does that mean? If you've got too many, think about this for a second. If you have too many workers, right, in an organization, and you've got one piece of capital or machinery, well, you're not going to be very productive because only maybe one or two workers are going to be using that technology, whatever it is. But if you've got more capital spread across a broader population, all of those workers are going to be more productive. So we really need to incentivize productivity enhancing capital. It could be in the form of governments providing tax credits. We got to do more in this, on this front, and we need to incentivize this to really move the needle on productivity, which will move the needle on GDP per capita as well in the positive direction. Now, the most unproductive sector of the economy, or one of the most unproductive sectors of the economy, is the construction sector, unfortunately. That's where we need to see that industry. We're building homes the way we did 60, 70 years ago. I want to share something very quickly, Tim.
Yep.
It's called modular housing, okay? In the book, I talked a lot about modular housing as an example of how we need to think about building homes. We've got to have more of a manufacturing mindset, right? Not a construction, a manufacturing mindset. And Mark Kenny from CapRate, CEO, posted something on LinkedIn. And good for him. He also talked about the need for more manufacturing housing. What it is you manufacture the parts that go into a home in a factory, and then you transfer for final assembly, you ship on site, okay? The costs come down by about a quarter, right? You've got fewer lost days due to weather, due to your employees calling in sick. It's tremendous. And we've seen tremendous progress with modular housing with the launch of the Rapid Housing Initiative. You may have heard CMHC launch that program. Tremendous speed at which we're delivering housing to lower income households, vulnerable households. What I'm saying here is let's broaden that technique out to mid-income households. So it does require thinking outside the box, right?
I have been approached as a broker owner
okay.
by modular house. I know there's a place at Woodbine and Aurora Side Road. They're actually building a plant right now for modular housing as we speak. Laneways are primarily modular. Laneway housing is modular. A lot of companies have approached me to talk about us promoting to you if you have a property with a lane and you want to rent a modular home, like go into a partnership with these companies as well, not just to provide it to you, but they're actually open to going into business with you. And then if you do not want that modular home there, they take it away after 10 years or 15 years. That's actually happening right now. Just letting you know.
Okay, well, so I think this is the way we need to sort of think about technology, embrace it in the housing space, because, as I say, we can deliver housing at a fraction of the cost, and that means lower prices for consumers than would have otherwise been the case.
I don't know if I would trust a condo being built as a modular, would you guys?
Well, condo, yeah. This is more missing middle kind of.
I'm just kidding.
Yeah, no, I know. Yeah. More missing middle housing. So that's just one thing that we can do to boost productivity. By the way, this notion that you can skin a cat one way is false. We've opened the floodgates on immigration thinking we need more workers because of an aging population. Yeah, immigration is needed. But maybe you don't need as many immigrants if you incentivize more technology in that space. You become more productive, you don't need as many heads on the floor, whether it's a business, whether it's a manufacturing plant, whether it's a construction site, right? I think that the other thing we need to really consider is capping immigration. I think we need more immigration, but we need it to be more measured and managed. We're bringing in 500,000 people, and we don't have the infrastructure to support that growth. How reasonable is that? I would argue, let's put a cap, whatever, on the growth. I would start with students. And I know that colleges and universities will be up in arms, but you've got to start somewhere, because that's what's fueled population growth. Until we see supply catching up, I think it's really, really going to hurt us by opening the floodgates.
Well, there's two things that I want you to share with you, guys. We're wrapping up here. There's two things. Number one, when it comes to what other countries are doing as a model, we need to look at what other countries do, right? When mayors or government goes to different conferences around the world and they talk, they need to take those ideas and bring them back. For example, in many parts of Europe, when somebody is a new immigrant to that country, they don't come with a trade, right? But the companies there are incentivized to train those people, and that employee commits a period of time with that company, right? It's actually a partnership with people who are immigrating to a country, right? So what you're doing is if you can't bring people in who have the proper trade, you're at least having some form of a government, I don't want to call it a grant, but a program, right, where that's going on. I know that my cousin who lives in Amsterdam was that person. He worked in the tourism industry in Greece, and he went to Amsterdam, and now he's an electrician. Like, he got trained and is consistently trained as an electrician, but he says, I love this company. This company has trained me to be the best I can be and has continued to invest in me. So I'm going to stick with this company. And I said, hey, have you thought about moving to a different company? He goes, even if I'm going to give up a few dollars per hour, no. I'm happy here because of what they've done for me and what I'm continuing to learn, right? But I also want to comment on immigration, if it's okay with you, Ted. You remember that story I told you about 5-6 years ago about the world and how it's changing? And here we are today, And I'll remind you of what that conversation was, but here we are today, and it's actually happening at exponentially faster. I stood up here in an AGM and I said, the world is changing. This is before any type of debate on climate change. And this is not a comment on climate change. It's a comment that the world is changing. Maybe it's going through middle life crisis. Maybe it's getting a little bit weird. We all get a little bit weird as we get older, don't we? Right? So what happens is the jet stream has changed over 50 years. This is factual. This is not to do, this is not about gasoline or coal or anything else. The jet stream has changed. So the weather we're having that we used to have in Vancouver, now we're having in Toronto, and the weather that's in Toronto is now in Vancouver, right? So if we're looking at what's happening in other parts of the world, there's over 90 million people displaced due to different changes in the planet. So what used to be a fertile, land that would create crops is now a swamp. That happened in Greece just several weeks ago, where 50% of the country's output in agriculture was wiped out. Like, we're talking about an area the size of Scarborough and East York underwater from rain that landed within like 3 hours, which should have been like 4 months worth of rain. So animals floating dead, batteries that were stored, tires, oil, wood, any crap that you can think of that was on land is now part of the ecosystem. It's wiped out. Those people now are displaced and they're moving to city centers. And they don't find a place to get a job at a city center. You follow where I'm going with this? So now they're hopping on a plane to go to a different country. And guess what North America is? A lottery ticket. We don't have the swinging storms. We have, just 20% of the world's fresh water is just where we live, right? Like, think about what we have as infrastructure. We don't have, like most countries still live on well and septic. We have even with our delayed infrastructure, we have infrastructure which is far more advanced than most European and Asian countries, right? So I have a slide that I was going to show. I'll just show it on the screen, but we'll go through it. But I want to also comment on immigration. It's far more just immigration. This is also policy that government, unfortunately or fortunately, it's well-spirited. It's a good heart, but it's putting pressure on other parts of the world, right? That's going to put pressure on housing, right? And that's real. What I just discussed with you. It's a real thing that's going on. Go ahead.
No, I thought we'd maybe end off with, I think you had some questions on micro policy.
The only question I have is on micro, yes,
yeah.
If you don't mind.
Yeah.
What role has municipal policy on zoning played historically? One needs to change here. And then we said, is zoning the silver bullet alone, or does more need to be done?
Yeah, we'll address it. Yeah, we'll address the
one
same
shot,
thing.
in the next 5 or so minutes, and then we could.
So we know that the heart of the supply problem can be traced back to, unfortunately, municipal policy, right? You all know and are familiar with the yellow belt in Toronto. There's a yellow belt in Vancouver, right? Basically, exclusionary zoning. You can only build single detached housing. You're not allowed to build any type of dense housing form. That's been a problem. Now, I don't know how many of you were here in 2021, a couple of years ago.
Yeah.
You may remember I was here in 2021, and I shared some modeling results with all of you on what happens when you rezone the yellow belt. What is that supply capacity look like? And I suggested to all of you that we can get about another 40,000 new units built across the yellow belt by 2030. Not overnight, by 2030, 40,000. And in some of those communities like Bloor West Village, and we were building like 200, 300 new units we were delivering on an annual basis, right? So just to put the numbers in context. The good news is we've been sharing some of those modeling results with different levels of government since 2021. And I believe we've had some influence, because you may have heard the Ontario bill, Build More Housing Faster, the need to upzone, 4 or 5 units, detached housing as of right. A lot of that, a lot of push from the feds, a lot of push from our team. And you may also have heard the city of Toronto green lighting multiplexes, right, early this year. again, building more missing middle housing. So a lot of the problems stem there, but is it exclusively just the fact that we need more density? Is that going to solve all issues? Probably not. Planning approval times on builder applications, far too long. 5-6 years to get, maybe more, to get a condo through the planning department, right? To get the green light to start building. 5-6, for low rise, 2 years, 3 years, far too long. So that's another problem. Government charges. I've never been a fan of land transfer taxes. You can go back. You can go back to the days of
Miller?
former Mayor Miller. You could probably pick out a quote from me back in 2007, 2008, why I felt that this was a bad move. I think Sean alluded to it. There's enough academic studies that suggest you actually restrict mobility and you restrict supply. There's enough literature out there. I'm not going to debate this point. We've done some work. Bad move. Development charge increases, 50% increase on high rise. Bad move. Another bad move because it makes the pro forma look ugly. Economic viability of anything looks bad. So builders are not going to basically move forward, right? But the city is running a $1.5 billion deficit. It needs revenue. There's things that can be done. You can increase the tax on vacant units. Now, you can also, it's not politically popular, I know. I'm probably going to. You can also increase property, you can lift property taxes on single-family housing and move property tax rates on new builds, high-density builds, multi-unit rental down. We've done some work there. That actually works. That actually doesn't just generate more revenue for the city from a volume perspective. It actually gets builders to build more. Tinkering with the property tax rate, either reducing it, eliminating it, or phasing it in for new multi-unit rental, works. Okay, we've done the pro forma work. How sensitive that internal rate of return is to just tinkering with that property tax rate. So these are some things that can be done. I want to come back to zoning quickly. Rezoning for conversions. So we've got a lot of vacant office space. Conversions aren't easy, they cost money, but where they make sense, fantastic opportunity to convert from office to residential, particularly in some core neighborhoods where, vacancy rates, commercial office vacancy rates sitting at about 15% in some of these neighborhoods. Convert where it makes sense. But again, we gotta rethink things like zoning. Does it allow for more office space? Secondly, this replacement rate is so archaic. So you take away so many square feet of office space, you have to replace it somewhere else. Come on, no. we got to rethink all of that. So I think rezoning for more residential conversions, I think makes a lot of sense. But the last thing I want to also say is, yeah, you can rezone for more density, but so there's other things that have to fall in place here. We talked about that. Yep. The Bazarian subway stop back in 2003 strikes home why governments need to be coordinated. Because even if you rezone or not, water and sewage capacity has to be in place, right? How many of you are familiar with the Bazarian subway stop? It was built in 2003. Ridership only took off in 2015, okay? It took over a decade for ridership to take off. Why? Well, the Bazarian subway stop is just in North York here. You can see it here in purple. Look at the slide to the right. All I see is yellow, right? Yellow belt. In other words, the property around that transit station did not support density. So how in the world do you expect ridership to take? Water and sewage capacity wasn't. So an example of how important it is for governments across all levels to be coordinated with transit, with zoning, with water and sewage capacity. All of that has to kind of fit together like a glove. Somebody said to me, you know, at the time I wasn't married, I was dating, and I was working up there where our offices were at Yonge and Sheppard. Somebody said to me, hey, Ted, why don't you take your date to the Bazarian subway stop? I wasn't aware of the Bazarian. I said, what? Why would I take my date? It's so quiet, Ted. Oh, my goodness. Okay, you want me to go there? Because how quiet is it? So I took a trip to Bazarian. You can hear a pin drop back in 2004. I think it was 2004. Anyway, all to say that, you know, zoning isn't sufficient. A lot more needs to be done, Tim. And I'll finish with this. I talked a little bit about development charges. We have to be smarter here. You could see a study that we released showing development charges per square foot on high density product in both Toronto and Vancouver is through the charts here. There's no way, there's no reason why DC should be this, you know, this high for projects that are being built where infrastructure already exists in many ways, okay? I think this is sending a wrong message to builders. You wanna incentivize high density? Well, maybe throw it on low rise a little more, you know, rebalance this picture. But as I say, I think we can offset some of the decline in LTTs, DCs by perhaps increasing property tax rates, increasing the tax on vacant units. Not so sure about sales tax at this point of the economic cycle. I don't know. That one hurts. But there's all kinds of things we can do to generate more revenue. Tolls. Hey, I paid tolls a month ago. I don't mind paying tolls if it takes me 30 minutes to get from point A to point B. And you know, you should pay your fair share of tolls if you're using the infrastructure. I truly believe that. But anyway, I'll stop there, Tim.
Oh, thank you, Ted. Yeah.
Because I want to
You're
respect
perfect.
the time.
Any
Yeah.
questions for Ted before we continue on? Oh, got a question, Peter.
How do I see the? Okay, so we're you know, in an inverted situation. So you know, again, when the long-term bond yield is moving higher, that yield curve that was inverted all of a sudden starts to become less inverted, right? So you start to see it slowly flattening out. Okay. But I don't think that we're going to get a normally shaped yield curve, which is upward sloping to the right, positively sloped. I think we're still ways away until we see that. I think that rate cuts are on the horizon, but certainly not in the next 6 months. I think probably back half of 2024, we'll probably start to see central banks starting to needing to revive the economy. I have some thoughts on house prices and sales, but I think Sean covered some of that. I don't know that we can rule out further price pressures. In fact, the data that I've been looking at in more detail suggests that we still have some more price pressures coming. Think of the.
I'll cover that for sure. I have some information on price and what I believe is going to happen.
My sense is it's a W. So think about a W where you start drawing the W. The first point is March of 2022. So think of a W formation. This is what I think, where the pickup kind of comes in, the recovery really gains steam back half of next year into 2025, I think. But a W is what I envision. But now I'm moving beyond your question, so that's fine.
That's okay. Thank you very much. Thank you, Ted.
Thank you very much.
Turn your mic off. So the great part of this meeting is that I'm the last person between, lunch, right? So my promise is to get through it as fast as possible so I can get you to lunch, right? And lunch is supposed to be at 12 o'clock, but we might be about 12:05 or 12:10, and I'm not going to feel disrespected if table by table you go up and grab your lunch and sit back down, but not everybody at the same time. How's that for a good deal, right? All right, so lots been going on this year in 2023, hasn't it? Aside from the market, there's also been an announcement that's happened between two very respected brokerages in the city of Toronto. Jamie Johnston and myself came together. We've been really, really close friends for over 12 years. We'd have lunch quite regularly with the one topic in how to improve the livelihood and the services of every single one of you in here, our broker agents, our business partners. And it came more and more to light that the best thing that we can do is merge and become one company. And that happened on June the 20th, just before the summer break. And I'm excited to have this because it just means that there's more power in numbers. It means that there's more services that will come together and provide efficiencies, best business practices, and everything else. But I know that there's going to be quite a few questions that may be asked inside our heads, but not verbalized outward. And something that everybody knows of me is that I'm always fully transparent and I don't hide anything. And the way I walk, the way I talk, and the way I walk are aligned. And I want to make sure that I answer your questions even ahead of you asking them, but I'm always open to having them as well. So now that the announcements happen, it's what happens to our offices, our locations, our staff, and what are our plans. Well, I want to say that what happens to our offices is absolutely nothing. As a matter of fact, what you all need to know is that I own the buildings, and this includes the actual office on Lakeshore, right? So 4 of the 7 offices are actually owned. They're not rented. The roots of the tree are very deep in the communities we serve. And that's something that should actually provide you a lot of confidence, because in an environment like this one that could last 6 months or last 2 years, that nobody really knows, right? But I have a good hunch of what it's going to do. You're associated with a brokerage which is rock solid, not just in the great times, but even in times of the ones we're going through right now, right? And I shared earlier that, I shared that earlier with you about the variable mortgages, for example, that we have, is because that just shows just what kind of strength we have together. So locations aren't changing. As a matter of fact, the 3 locations that are not owned, which is Harbor Square and the 2 on Bay, the one on Bay, we just renewed the lease for 5 more years with an option of 5 more after that. It's not going anywhere either. And we have great plans for those, as actually to create one of those Bay Street offices into a commercial division where we can have a proper commercial office as well, is what our plan is, and have all the agents who are commercial, and possibly using the Bay Street address. Our staff, it was very important to both Jamie and I that they're all here today. They're actually in the back tables right there, and I want you to give them a round of applause because they're right there. If there's anybody who would feel any form of discomfort or any type of what the future would hold, would be them. But let me share something with you. This combined initiative has combined 9,671 transactions done in the past 12 months between both brokerages. I want you to do that calculation. 9,671 transactions were done between both brokerages. So as you can see, we need all the help we can get to keep you guys paid, right? So there's no plan to do anything more than create efficiency and actually less stress on them, right? But I want you to do your own math on what that means. 9,671 divided by 410 agents averages 22 transactions per agent per year. The average in TREB is 2.9. The average for RE/MAX is 16.5. Pretty good, isn't it? Right? You're surrounded with giants here. Like you're talking about being part of a downtown, midtown brokerage, which Sean earlier talked about, dominates the condo market and dominates the middle core of the city. And our goal is that when people think of RE/MAX Ultimate and RE/MAX Condos Plus, they think of you, right? And vice versa. So that's our goal. And what are our plans? Our plans are to connect our phone systems. Our plans are to connect our banking system. Our plans are to connect the key fob system so you have full access. The plan is to connect our phone system and answering, appointment desks so, you have more people answering the phones. Our plan is to plan to do better every single day, right? That's our plan. There's no other plan. Now, I've been asked already, what happens to the name Condos Plus? Do you have a plan? We don't have a plan. on that one, right? What we know is that there's a lot of value in that. 178 agents at Condos Plus, over 100 of them are part of sub-brokerages who don't share the name Condos Plus, right? So our promise is to talk and survey and see exactly, what that name means to the individuals who use it, and use it, in some capacity, some way moving forward. Would that be accurate? But there's no other plan aside from that. And we had a meeting with our staff. We made it very clear, that our plan is to actually support each other to make this transition as easy as possible moving forward, and nobody's left behind. And if somebody stumbles and falls, we help that person, what a true team does, be better, right? We don't just let them aside and come back and say, oh, they don't have what it takes. And as a matter of fact, we're both really excited in our private meetings of just how much they've already cohesively come together and help each other, especially between Nikki and Yasna, sharing a lot of ideas, on how to do things. So, moving forward, I acknowledge it's been a roller coaster ride. Earlier today, when we started the meeting, I talked to a few of our agents, and I said, there's a lot of noise out there. A lot of noise. There's a lot of people who are actually getting bombarded in so many ways, with change. And with change being so dramatic right now, especially with AI and everything else, it's easy to get mad and get upset. Because when we don't understand something, we create a conspiracy, or we create something inside us that is not a defense mechanism that gets mad at everything around us. We see the emotion, and we just want to help you get through it all, right? Because the change that's going on is from the people around us. We talked about, I don't think they look very smiley up there, do they? It looks like they don't know what they're actually doing. Some of them look like they got caught doing what they shouldn't. So, I mean, it's the real of what we're going on is, who are you going to trust, right? In my humble opinion, politicians have two ideas when they win an election as they're walking to the mic. As they're walking to the mic, they're thinking two things. One is, my thank you speech. What's number two? How do I win again? Right? So, what's happened today in politics is something that has been unprecedented. They poll every single day. They're always looking for your ear. They're trying to capture your mind. They're trying to figure out a way. Instead of trying to work on solutions, they're trying to survive for themselves. And, I don't believe, they know what the interest rate environment is going to be in a year from now. That's the way they promised earlier, that it's going to be low for 2 years, and now it's a lot higher. But I do agree with what Ted said, respectfully more than what Sean said, that, there is the higher possibility of seeing one more rate increase, right? I do believe in my gut that there is room for one more, and you have to brace yourselves for that. And that is what's going to add to what I believe is going to be a possibility over the next 6 months to see an incremental price decrease in many areas around you, right? But before I talk about that, I want to talk about CREA, OREA, RICO, and TREB. They're also in our faces, a little bit too much. How many people like sports, right? You watch a ball game, a hockey game, a soccer game, and you watch two teams competing against each other, beating the crap out of each other, and they win. You say, wow, what a game. And how many people have watched the game where the referee is the star? Right? The referee thinks he's the main player on the whole sports team, right? They're calling people out, throwing people out, putting them in the penalty box, right? I think that these people are those referees, right? That's what they're doing. When you're looking at what, OREA has done with the wellness program, I know many of us are not in favor of it. I do believe they had a good spirit towards it. They has a good intention of it. But obviously there's a lot of anger and upset, emotions out there about it going through. I've tried in every single way to find out a way out. I haven't had a way at finding a way out. I have not found a way to have a way out. When I look at RICO and TREB and RICO have almost become one, ladies, like everybody in this room. I'm letting you know they've almost become one. As a former president of TREB, I have a lot of admiration for what they do, but they're acting like a regulator. If we come back to you and we're asking you for paperwork to be done a certain way, it's not because we're being difficult. It's not because the admin team is being difficult. They're actually trying to protect you from a fine. I've gone to TREB as a former president, been found innocent, but they still provided a $500 fine to our agents because of the time they spent with us there. Okay? Like, I want you to understand how bad it's become. FinTrack. We have 2 FinTrack officers right now. What we have at RE/MAX Ultimate that we want you all to do is log into Achieve, do the FinTrack course. Once you're completed, you get a certificate. When, and not if, we're audited, that demonstrates as a professional that you've actually gone through and updated yourself on FinTrack, right? FinTrack is, we got audited once about 7 or 8 years ago. Probably the worst experience I ever had. It was a young lady who came in. She was wearing a white shirt, a black power suit, hair tight in a bun, glasses that were printed on her face, and I made the biggest mistake ever. Can I offer you a glass of water? It was deemed a bribe. I'm not kidding. She made it very clear to me that that's deemed a bribe. Don't talk to me. Leave the room. I'm investigating. Right? I'm surprised I still have nails on my hands. Right? So it's real. Like, it's real. So when we are asking for FinTrack, it's not because we're being difficult. It's because there's no room for error with them. You know, having an excuse as housewife or homemaker does not count. Having an expired ID does not count, right? We need to protect you from what the scrutiny that our industry is under with money laundering and terrorist activity and everything else that goes with it. So we need you to be partners here and understand that. But let's talk about what the government's really looking at. How many people remember this slide, right? This is what it's going to be like for the next, couple of years. It's going to be, how are we going to make money off real estate, right? Whether it's the increase of the land transfer tax or anything else, they're going to look at these things. The buyer sees their home modestly. The appraiser sees it very small, especially now with, responsibilities, people not wanting to lend money as easily, being a lot harder, And this is a great slide. I used to use this, and I'm sure many of the vets in the room used to use this back in the day when they went to listing appointments, right? This is probably one of the best, objection handling slide if you make it prettier. I just found it, and photocopied it. It tells you how old it was when I used it, right? To actually use it with pricing strategies, especially right now. So government policy and market questions, the Toronto vacancy tax is something that's going to be coming for sure. It's going to go to 3%. The reason why I put it up as a reminder is because we need you to remind your clients on an annual basis or whenever the government sends out that form to make sure that you actually complete that form so they're not paying 3%, on a vacancy home tax. And the new graduated MLTT, I've always been against the land transfer tax. I always will be. But I also know that the City of Toronto cannot balance its books. And the only way you can do it is by actually increasing realty taxes across the board. But it's political suicide. That's what Ted did not talk about, is political suicide when it comes to raising the actual realty tax. But I know that the City of Toronto cannot run a deficit, but the provincial government can. So my solution has always been, why give people a free sticker on their license plate? Why not just abolish the LTT and let the City of Toronto have it? As a matter of fact, why don't you let every single municipality in Ontario have it and not Ontario have it? Wouldn't that make a lot more sense? Instead of giving a $1.5 billion deal somehow, just handing out money, calculate where $1.5 billion would be in their books and make a reduction in the Ontario provincial land transfer tax. I don't know, that makes more sense to me. It's easier to balance, right? But it's going up, and I have the graph right there, 3.5%, at 4 million, and it's going to be, it's 4.5 at 5, and on and on and on. And that's going to definitely create, a transfer of who pays for it, and the home seller is going to be paying for it. You're probably wondering, how is the home seller going to pay for it? Quite simply, prices will be pushed at those incremental levels. If you're at a $3 million house, now somebody's going to pay, right, for that. If you're at a $4 million house, somebody's going to pay for that. Moving on, I said earlier, inflation is definitely going to be a very stubborn one. I do not believe that it's going to drop to 2%. I believe it's going to be a new world when it comes to it. And I already commented earlier on immigration and e-commerce and how it's never been really discussed. The prediction of rates being lower in 2023 is definitely off the table. As a matter of fact, we may see one increase more. But, you know, I want you to look at what rates used to be and educate your clients. How many people remember 2008? I hope so. We've all been around, right? We had a financial meltdown, didn't we? We had banks, you know, going out of business. And we had a Canadian dollar that was at par with the American dollar. And I wish I took this person's advice, Jamie Johnston, who bought a place in Florida at par. Think about that. You buy a condo at $200,000 even Steven, right? And I'm like, Jamie, I don't know, you know, really? Now he got a 35% increase on the dollar and he got a 200,000% increase on the value, right? But have we seen the Canadian dollar and the American dollar at par ever since? Have we? No. It's been a long time, hasn't it? So when do you think you're going to actually see interest rates? Are you actually going to bet your career on seeing a 0% or 1% interest rate again? No, I wouldn't bank on it. As a matter of fact, you have to look at what the averages have always been. And I have on the slides there what the averages have always been. And I also look back over 50 years on what the 5-year rates have been, and the 3-year rates have been, and the 1-year rates have been all along. That's a more normal market. And with the lack of construction, and the lack of housing, housing coming to market fast enough, when rates, and they will, within the back half of 2024 start to adjust, and when we do end up in that 3.5%, 4%, now we're going to be in a better place as an industry. My best year in real estate as a broker that made me the happiest for every single agent was 2007. 2007 was the best year because we had supply, we had interest rates that moved down from the 6.5 that I got in 2000, right? And everybody was doing deals. Everybody. And then 08 and 9 after that was kind of crap because of land transfer tax and everything else, right? But 07 was the year where rates were normal. Like they were what the average would be, you know, I mean, they're still high posted, but that was not what the rates were. Our rate was, I think, somewhere around 5.5, 5.25 at that time, if you remember correctly, right? So I talked about world events. I actually have the slide here. I'm not going to go over it in too much detail, but look at Africa, 86 million people are being displaced. South Asia, 40 million. Latin America, 17 million. These people are moving around because the world is changing, I said. I have it up there. You can watch it. You know, again, after this meeting today, you can go back to our Achieve site and you can watch the actual slides. And I actually like to write out things that are there so you can actually get the context of the slide. Again, going back to government policies, a reminder of how interest rates affect sales as a whole. And this is something that I learned with Ted in our conversations. Now, I didn't say this to you, but Ted and I talk on a regular basis. We like to debate quite a bit on what's going on a macro and micro level. And I know that I affect his decision process on a micro level, and I know he affects my decision process on a macro level quite often, right? And we actually find a middle ground. This is something that I learned from him in the modeling that he's done at CMHC. You know, for every 1% increase, there's 7,000 less sales. So it gives you an idea of pressure. And decreasing sales also contributes to decreasing spending, right? So for every $1 value decreases, it's a 5-cent less decrease in spending that's happening. And that's what I meant by the slowing down of the economy. It takes time to go through with it, right? Again, we talked about a lot of the stuff that was already discussed. I'm not going to go through it, but I will. I also shared that 65 to 75% of home mortgages are coming up for renewal in the next 1.5 to 2 years. That's very much in line with what we heard from Sean and from Ted earlier. What I really want to talk about is what I'm seeing from all of you and what we're seeing on our Broker Bay appointment desk. We're seeing decreased appointments on your listings. We're hearing of your open houses not having as much traffic, right? This is something that is real, that's going on across the board. If a home is priced right, staged, move-in ready, it is the first one to sell. It's still being absorbed very, very quickly. But that's the key. And I'm also hearing a lot from all of you is, I have clients who want to test the market. Don't participate in testing the market. It's not going to accomplish anything aside from you spending more money that you can invest in other places in your business. This is the time for you to be strong in your resolve and be a true guide to every single one of your clients and educate them and keep them, really up to date. And we have seen a 20% increase in supply across the board, but we're just not getting the activity. But I am seeing also sales and rentals that are being done. You're still very active, we're still very busy, we're just not at the rate that we used to be, and it's very normal. The spring is a time of rejuvenation, isn't it? The leaves are starting to, bloom, and the weather's getting a little bit warmer, and people are thinking about their cottages and buying a car and doing things, putting their house for sale. The fall market's always a lot tighter, isn't it? Like you get back in August from your holiday, you think about real estate for about a month, right? And then it gets kind of darker, right? You're back into the routine, and now you're thinking about Christmas all of a sudden. Like you go to the store and it's September and you're having Christmas decorations up already. You're like, what's going on here, right? And then you compile all the things that are going on, that are going on with the economy and the politics and, the media, and it puts things in a little bit of a darker place. So we're going through that right now. And I have the financial roller coaster and the window of opportunity. I do believe that right now, there's no, even though the graph talks about hopelessness and depression, I don't really mean it in the context of the word or what it means. I'm just talking about the lull, that bottom point of the market. And I do believe that we are going to have those headwinds that Sean talked about. We are going to go through this market for at least 6 months. Like, I'm standing up here as your broker of record. I do not believe for a minute that it's just going to turn on a dime, right? But there's going to be a lot of opportunity. If you have a seller who's leaving the market completely, the worst place to be. If you have an investor who can't afford the place they bought, the worst place to be. But if you're an investor, you're representing buyers who just got married, just got a job, this is the best place to be. This is the best place to be, especially with rates coming down, right? At some point. You can't time the market 100%, but you can time the market within 5% or so. And that's what I think people have to do. This is the window of opportunity. And, I talk about that, moving forward. This is a time that each and every single one of you have to look at your marketing plan, and you have to double up on it. Not double, you have to really, really do it better. How many people remember a time in their career at some point where they ran an ad or they did something in their business that was successful, like really successful, right? But what you've done now, or what we're doing now, is we're looking for the new thing to do. Why? Go back in your data bank and think about what you did before that really worked and do it bigger. That's my message, right? This is the time to take away the market share from the agents who are not going to work. This is a time, in my humble opinion, where agents are going to leave the business. This is a time, I believe, that brokerages are going to close. I believe that. I believe there will be brokerages that are going to close. I believe that there's agents who are going to retire. I believe there's agents who will not want to pay the wellness program, and that's the last straw that gets them out of the market. Do you know that for every 3 deals you do, you knock out an agent out of the business? Simple math, right? The average on TREB is 2.9 deals per year. So for every 3 deals you do, agent gone. Right? Think about it. This is your chance. I have a thing that I used to do every single year in my business. And I'm going to tell you what that is. Wrap up your business? This is what you're going to do. Look at every single transaction you've done this year and ask yourself honestly, what could I have done better? What could I have done better? And then what you're going to do is you're going to take that and go to the client that you serviced. And you're going to apologize to that client. I'm not perfect, and you're not all perfect. My wife reminds me I'm not perfect. My kids remind me I'm not perfect. We all kind of let things slide a little bit, right? Like we got a little bit busy, things didn't work out the way, and you're like, oh, I don't feel comfortable. We had an agent in our company once, in our brokerage, who actually went to a past client, and the client closed the door on her. And our agent knocked again and said, I'm here to apologize. I want to review the, When the agent was done the conversation, humble, she also left with a referral. It's okay, right? But it's your character that you're building by doing so, right? Like you're going back and you're making things right. Instead of passing the buck on whose job it was to fix the dishwasher or the garage door opener, take ownership of it and do it, right? So, and in social media, I want to share this. It's in my heart deeply. 5 minutes. Deeply in my heart. Be careful of the spotlight phenomenon. Be careful of the spotlight phenomenon. It's very, very important. There's a way to do social media right, and there's a way to do it wrong. I'm a big believer in social media. I want you to engage in it and do it all the time. But stepping out of a sports car with your hair flowing in slow motion, is not the right way to do it. Right? You have to be more interested in than interesting. You have to provide value by educating, not talking down to. There's a way to be on it, and there's a way not to. And I'm going to share with you that there's also a way to do it right, because you have a responsibility to your co-partners in this room, and you have a responsibility to the industry. We are the masters of making industry rise or lower, right? So I believe that you need to do that and be, and again, at the end I say, just be authentically you and work with the people that you want to work with. In closing, I want to introduce our marketing department. Jackie is the marketing manager. Jaden is our in-house marketing coordinator. Just to let you know that we've brought everything in-house. We're no longer outsourcing in any way. They will do all your design work in any way that you need. And then we'll send you to, you can use your own printer, or we can send you to printers that we've associated ourselves with, but it's no longer the old relationship. It's all done in-house. And Tristan is our social media person. Tristan is the person who's going to be doing our social media for our offices and providing services for all of you. And please join the WhatsApp group. If you haven't joined it yet, you've been invited many times. The WhatsApp group is a networking group between both brokerages. And the whole idea is to network with your fellow agents. It could be for anything from an assignment sale to an open house request. It's great. Your one-stop shop, that's where you find all your essentials. It's under My RE/MAX Ultimate. We'll be sending a recap with all this information as well. And this is where this meeting is going to be housed, is this website right here, achievetheultimate.com, right? And this coming next week, almost a week tomorrow, right? October 4th is a event that we have collaborated with and sponsored with. It's $129 plus HST, but we're giving you a $30 credit if you attend. We're actually paying for this. We've actually come together with 9 other brokerages, Jamie and I, across Southern Ontario. It's an exceptional event. Jared James is an amazing speaker. If you haven't seen him or heard of him, he is really, really good. We have Suze Cummins, who is the art of negotiation. She teaches you all the mindset of negotiation with people. And actually, Dan Wood, many of you already know, is a tech guru. And mark your calendars for the holiday Christmas party. It's going to be right here in this establishment, actually much bigger than this space. The first Thursday of every December is always going to be our Christmas holiday party. Awards night, February 29th, 2024. Mark your calendars for that. It's always the last Thursday of February. And who's going to go to Las Vegas? Maybe we all go together. Yeah, hands go up. You know, we'll go maybe we'll talk about March 25th, 28th to Vegas. And with that, I want to say thank you for joining us, because I have lunch over here and they're looking at me doing this to me the whole time. And I don't want anybody hangry at me, right? Do you have any questions before we move on? No? Listen, everybody, thank you so much for being here today. Enjoy lunch, and we're always here to help. Ha!